Guys, it's Stan here. Today we're gonna talk about sustainable finance. So is it just the next greenwashing product or is it the next big thing? Well, let's find out together. So let's try to define sustainable finance. As you know from this channel and from my metrics video, usually you see that in finance, financial metrics are key, such as revenue growth, EBITDA, free cash flow, and these kind of things. In sustainable finance, these financial factors still are very important, but there is also a new approach here. Actually, in sustainable finance, the famous ESG, environmental social governance, takes a bigger role, which means that investors and companies are not only looking at financial metrics, but also at the environmental impact and the social impact of the company or the investment. So the origin of the famous ESG actually came up in the early 2000s and followed the big Nike scandal with the child labor in Southeast Asia, and this was basically the result of this famous scandal here. So a lot of things have changed since 1996 when the scandal took place, the Nike child labor scandal, and especially the approach was very different, because at that time Nike was saying, and that's why they were criticized a lot, they were saying that, well, but it's a third-party company that works for us, so we are not controlling if they are hiring people and kids in the sweatshop. So that was their response at the time from Nike, and obviously a lot of things have changed in the last 20 years. So actually, since the scandal, a lot of companies have understood the value of ESG, because when you look what happened during the scandal and during the last 20 years, companies who were really damaging the environment and who had a lot of social issues in poor countries, for example, they had a pretty big impact when it comes to brand recognition, brand value, market capitalization, and these kind of things. For example, look at all the oil companies back in 2007. They were at the top of the ranking when it comes to market capitalization, and when you look today, like 13 years later in 2020, where they are, you see that a lot of things have changed in the last, let's say, 15-20 years. Okay, now that we have talked about the history and the reason behind environmental social governance, let's talk about the different types of investments which are related to this sustainable finance topic. Actually, there are three types of investments, going from low ESG to super high ESG. So let's look at it. First of all, and that's the easiest step, when you look at, for example, an exchange traded fund or a mutual fund, you know, these pretty big asset managing companies who are investing in the market and in finance. There are actually three types. So first of all, there is something which is called negative screening. What is negative screening? Basically, the asset manager who is investing in the market, let's say he's investing into 100 stocks, and he's gonna take out for example, the tobacco companies and the gun companies. But in this case, as you can see, the oil companies, for example, and everybody knows that the oil industry in general is a heavy polluter in this world, and transport and everything is still inside. So in the negative screening, actually, they are taking, let's say, 100 stocks, and they are getting rid of the worst, let's put it like this. Then the second type of investment is what is called ESG integration. And here it's a little opaque, because actually, as you probably know, there are some websites and a lot of companies. It doesn't matter if it's consultant companies or companies who are producing goods, are calculating ESG factors. And in this case, actually, let's say the fund manager or the company who is investing is taking into account these ESG factors. So that's kind of a little upgrade compared to here. So which means in this case, actually, the ones with very bad ESG factors will be out. And then there is kind of the top of the line when it comes to environmental social governance. It's what is called impact investing. So what is impact investing? And here you will see why it makes sense in my opinion. It's actually, in this class you are investing only if impact can be quantified and measured. For example, they will look at a company and see, okay, this firm, for example, they were able, compared to last year or the last 5 years or something like that, they were able to reduce their CO2 footprint by, let's say, 20% or something like that. So that's clearly quantifiable and measurable. What the problem of these is that when it comes to CO2, for example, so when it comes to environment, it's pretty easy to say, okay, compared to last year, we have done a few measures and we have less CO2 emissions compared to last year. But what is pretty complicated is think about the social impact. Let's say if one of your projects in a company led to the education of 20 schoolgirls in Laos or something like that. That's pretty complicated to calculate here, because it's not it's not the same metric when you're talking about the environment as when you're talking about the social component. So here it's gonna be difficult how it's factored in, but impact investment is definitely getting big, and the reason behind it is actually the goal of all these funds. It's always the same, and this is why it's gonna either make or break sustainable finance. The goal here is clearly no need to sacrifice financial performance for non-financial goals, because obviously as a financial investor, even if you care for the environment, you don't want to destroy your future returns just because you're taking care of the environment. You want the contrary, actually. You want that because you are factoring in the environment, you want higher returns. So now let's look at the bigger funds, how they're managing it and what's going on. So there are some good signs that sustainable finance is getting bigger and bigger. Maybe you know what the letter from Larry Fink is actually. Each year the founder of Blackrock, which is the biggest asset manager in the world, is writing a letter to the CEOs of the world and all the companies he's investing in. And this year was a pretty big change because he was saying that I believe we're on the edge of a fundamental reshape of finance, and he wants his companies to disclose more and more information when it comes to environmental impact and CO2 emissions and these kind of things. So I do not believe he's doing it, and on all the big guys who are getting serious right now, they are not doing it to save the planet or something like that. But I think it's comparable to organic food in the supermarket, for example. Supermarkets are not putting organic food in the supermarkets just because they are just great and they love organic food, but that's because they have spotted the trend that customers want organic food, so they are supplying them. They are supplying this demand. That's the same which is happening with finance right now. It's not because we want to live in a nicer world or stuff like that. It's just that the big guys in the business, the big hedge funds, the big asset managers like BlackRock and Vanguard are realizing that a lot of my clients are younger and are getting wealthier right now, and they are really focused on this sustainable finance. For them, ethic plays a big role. So since there is this demand, we have to satisfy this demand. And that's pretty easy. That's why he's asking all his companies, okay, please make sure to be more transparent when it comes to CO2 emissions and these kind of things, because our customers want it. In my opinion, another reason why sustainable finance will get big in the next couple of years, even bigger than right now, is simply what is happening in 2020. When you look at all the wildfires in California, all the floods, and obviously the coronavirus, all these things are related to environment, and everybody starts to noticing it. Think about the coronavirus, for example, which obviously everybody knows that it came from China, and because there was contact between some people and kind of jungle animals, so actually it's clearly an environmental problem, and this is one of the reasons. And same for the floods and the fires. People are realizing that there can be some massive consequences from CO2 emissions and the environment in general. And it's not going to be in 20, 30, 50 years, but it can be already now, and we are feeling we are seeing the effect already. And I think the psychological impact on the investors will be huge in the next couple of years, especially when you think, how is a stock working? When you're buying or picking a stock, you are not judging the company for historical past performance. Nobody cares about that. That's not what is reflected in a stock price. But what is reflected in a stock price is the future growth, the future opportunities, and the future risks as well. And going back to the letter from Larry Fink from Blackrock, he's saying that clearly companies should state in their reports the future environmental challenges and risks they see for their business. So this is what I was just saying about the stock price. Stock prices are related to the future, and as the future is getting darker with environmental changes and destructions and stuff like that, it's going to be more and more reflected automatically in the stock price. Not because people are green and happy and everything, but because it's just how stocks work. So that's why I think that sustainable finance, if it gets more and more transparent, will become very, very big. And we are seeing it as well with the green bonds, meaning actually right now a lot of companies are getting into the green bond situation, where actually they are issuing new debt which is related to or which is linked to some social and environmental friendly behaviors. Let's put it like this. So the entire market is going to greener trends. Not only I have talked about the fact that I really believe in sustainable finance in the next couple of years. I think it's gonna become very big. I think there are also a few downsizes I wanted to tell you here. So first of all, absolutely key in my opinion is transparency. Right now it's very intransparent, very opaque to know which company is very green and which one is not very green. So obviously a fund which is actually a sum up of a lot of companies can only be as transparent as the companies itself. So that's why I believe that, for example, the letter from Larry Fink and what BlackRock's gonna do in the future will really depend how sustainable finance will evolve. Let's say if BlackRock, for example, is super strict in their investing strategy and want a lot of details, then I believe it's gonna work out fine. The question is obviously if companies like big oil companies can buy their rights to be dirty, kind of. It's gonna be a different topic. Then obviously transparency goes with trust. Right now I think green finance sounds a lot like a marketing slogan, because it partly is a kind of a marketing thing, like with everything which is green and organic and stuff like that. But I think in the long run, companies which will be greener than others, and I think Tesla is a good example, will outperform the market, and in the long run they will win, because usually in the long run, think about Amazon for example, when you have a very long-term vision, usually you win. Then obviously, performance gonna be key. As long as green indexes will outperform the dirty ones, well, the choice will be fairly simple. One thing I have in mind here is clearly diversification. How diverse are these funds? I'm not sure that right now you have, when you look at the S&P 500, for example, the 500 biggest companies in the US, it's super diversified, different sectors and these kind of things, because there is no selection between dirty companies and clean companies. But if you're only taking the clean companies into a fund, I think diversification will be key, because, for example, if transport and energy is not in, for example, you are missing these kind of industries, you know what I mean? So If only restaurants and hotels, for example, are inside and you have a year like 2020, then you know why diversification is important. And last but not least, I would say that it's it's always gonna be highly subjective, you know, because what is socially responsible, that's kind of a big deal. It's a big question, and I think everybody has a different answer. Let's take the meat industry, for example. A lot of people think, and if you're a vegan, for example, you think that meat is bad in general, and a lot of CO2 emissions come from meat. So a lot of people maybe will not invest in these kind of companies. But that's highly subjective, because a lot of people who love meat will say, well, it's kind of part of our history and part of our human nature, so it's good. So that's really gonna be a subjective decision here. Okay, now that you know what sustainable finance is, I wanted to know, maybe in the comment section below, what is your opinion? Do you think it's good, it's bad, and how it's gonna evolve? I also wanted to tell you that I post once a week every Sunday, so if you're interested by these kind of topics, corporate finance, market finance, you know where to find me. I'm also on Instagram if you want to follow me, Stan the Finance Man. See you soon, guys. Bye bye. Don't forget to subscribe.